Hey everybody, welcome to today's Tech Talk Tuesday from MarketEdge.com. My name's Rachel, and with me today, as usual, is David Blake. David, how are you today?
I'm doing well, thank you.
Awesome. Let's jump right in with last week's market letter and look at this week's market.
Okay, well, we had a rough week last week. We came in on Monday with a little bit of a relief rally because the Mideast conflict had remained contained over the weekend. But as the week progressed, yields moved higher and the major averages continued to tick lower throughout. We had several Federal Reserve officials during the week come out and just reiterate that yields were going to stay higher for longer. And some thought I was a little bit dovish in the fact that we still have the fact that Chairman Powell is saying we're probably not going to raise rates on November 1st, which is next week's announcement on Wednesday. So that should keep rates where they are. Um, we did have rates this morning before on Monday. We're doing this. The 10-year yield did tick over 5% again before pre-open, but then we actually started to pull back, and as the morning progressed, I think the 10-year actually pulled back to about 484. So it's a pretty good pullback on that, which allowed equities to take off and have a little bit of a rally after morning drop. Now they're kind of giving them back in the afternoon, so we'll have to see how the day ends. But I'll get into that a little bit later on. We also saw crude oil prices push back towards $90 a barrel last week as tensions picked up in the Mideast. I think today we're kind of flat, but we're holding up there around between 87 and $90, which are probably where they'll hang out for a while here, depending on whether we start to see more bombs flying from Iran or whether this thing really starts to pick up in here. Okay, the market sectors were mostly lower. We did see consumer staples and energy, punch out some modest gains last week, but then the REITs, consumer discretionary, which is part of that was due to Tesla having about a 10 or 12% drop because of more they missed on the bottom and top lines. And financial materials and industrials, they were the sectors that were the main laggards. They were all down more than 3% last week. So a rough time to be in those sectors, a rough time to be in equities in general. I know I looked at my account today and I've basically given up the whole summer rally. I think the major averages have too at this stage, or very close anyway. Okay. So anyway, after ahead of the weekend, we did see another big sell-off on Friday. Different indexes extended their losses. The S&P was down 4 days in a row to finish up the week, and the NASDAQ was negative for a second straight week. So again, we're not seeing much traction here in the different indexes. They're kind of going sideways, especially the big cap tech stocks, which are kind of holding things up a little bit. Okay, the technical condition of the market did deteriorate last week, with the major averages finishing down. All the different technical indicators are now negative. MACD, which kind of measures the short-term trend, it's negative in bearish ground. We also saw momentum, which we have several different gauges we look at that, but the 14-day RSI was negative and getting weaker. Now, if you listen to some of these tech talks in the past, we talk about a red flag on the 14-day RSI is when you see that indicator fall below 40. As long as if you're in an uptrend and you stay above 40 on any kind of a pullback, it generally means that the trend is still in decent shape. Some of these indexes were down to 28 and 30, which means you basically have you're in a negative trend now, bearish momentum. And until we see that 14-day RSI, even on the rallies, on the upside, you need it to cross above about 68 or so. Then you may be looking at a trend change. But until you see that, most bounces or dead cat bounces or relief rallies, whatever, are going to stall out around 55, 60, something like that on that indicator. Okay, we have the Dow Jones, the S&P 500, the transports, the small cap Russell 2000. They all finished the week trading below their 200-day moving average. The S&P 500 broke that key support on Friday, which was around 42.33. As we speak today, um, we're at 42.36 right now. So it's just kind of, after this a little bit of a pullback here this morning, the relief rally carried it up to about the 50-day moving average, and it's kind of stalled there. It's kind of spinning its wheels right now. If you remember, we had some targets here a few weeks back for the Dow Jones coming off of a head and shoulders pattern. It targeted 32.8 to 32.850. We have hit that 32.8, 38.850 a couple times here the last week or two. The NASDAQ off of its head and shoulders pattern um, would target somewhere around 12.3, 12.350, but it does have support at 12.730, which is its 200-day moving average. Um, we haven't got down to that yet today. On the early this morning, it came close, but not quite. And then, of course, the S&P 500 target was 4170 off of the head and shoulders target, and that's also below the 200-day 200-day moving average for that index. So it's trying to hold that one. We'll see if it if that'll hold on to it. I think at this stage, I think it's very possible that maybe that'll be the bottom on these targets. That's 4170 on the S&P 500, and again the 32.850 for the Dow Jones. The underlying breadth, that's the advanced decline lines and new highs and new lows. They're still negative. We, generally what we look at the AD lines, which is the advanced decline lines in the NYC. It's kind of a leading indicator for market direction. And often and most of the time, you'll see that AD line turn up before the market turns up. When you're getting near a trend change, we call that positive divergence. Or at a top, if you see the market starting to make new highs, yet the AD line is drifting lower, and that's called negative divergence, and that's also a telltale sign that you're probably at a turning point for the different indexes. 52-week new highs and new lows. The new lows continue to outpace the new highs on both exchanges, and they're expanding a lot. And I think on Friday we had on the NASDAQ, you had 529 new lows to 9 new highs. That's not exactly a sign of strength for what's going on in the market. So that's something that it's going to have to take a while to work its way out. We're still kind of mixed to neutral on the investor sentiment. You did have a little bit. The retail investors are getting a little bit more bearish in here, but we do have the pros starting to. They're starting to nibble away in here. They actually have jumped from their equity exposure from 36.2% exposure just 2 weeks ago to 66.7 last year. So they've doubled, what their the amount of exposure they have into equities right now. So that's something to watch. And that's kind of it. The momentum is negative. You don't have a lot. You only have 17 industry groups that are either strong or improving. That includes, oil fields and coal and oil field equipment, that type of thing, and pretty much everything else is weak. We did have a little bit of a bounce in transports here about 2 weeks ago. That's basically giving all that back again, with as the prices go up with the oil and all, the fuel costs go up. That's hurting the trucking stocks. So the railroads are still in fairly good shape, and the airlines, and you're also even the cruise lines with the Mideast conflict. They're seeing less and less. Less and less, desire for people to want to travel overseas at this stage. So anyway, that's how we're looking at where we're at right now. The CTI, I mentioned here that we were going to be bullish, and we are. We're going to be bullish probably for another week or two. But I have mentioned several times in the letter that the short-term cycles that we follow are bullish, but the dominant cycles, which are the D and the E, which are the 54-month and the 18-month cycles, they are still negative. They have yet to bottom. So we still that puts more downward pressure on the cycles, even though the the short ones have turned bullish. So by that I mean that I don't see much upside in here, even if we get some solid earnings from the big cap players this week, the Microsofts and the Meta and the Google or the Alphabet and Nvidia and stuff. I don't think that you're going to see this all of a sudden, boom, here we go. We're gonna have a nice end of year rally starting from that. You've got like I said, you have too much stuff going on. I know the market likes to climb a wall of worry, but this wall seems a little bit too steep to me right now. So we want to watch that. Now, often we've been talking about what you need to be doing as an investor right now is just keeping an eye on uh, the yield, especially on the 10-year yield right now. And of course, as we ticked above 5%, you see stocks sell off. They are trying to, we pulled back today, so you did have a little bit of a bounce in equities today, but now it's giving it back up. I said you have the NASDAQ higher on strength in the big cap, mega cap stocks that are going to report. Google's positive, Microsoft, Meta, Apple, and that kind of thing. But besides that 10-year yield, for shorter term traders, what I want you to do is you can kind of take a look at Alphabet and Microsoft, especially today and tomorrow. Both of those stocks have come down to their 50-day moving average this morning and have bounced off of that, which means that on a technical basis, you have traders coming in looking at that as support and hoping that maybe if they come in and they blow away some earnings estimates tomorrow, that we could probably get maybe 2 or 3 days of a bounce. The numbers I want you to watch on Alphabet, if it breaks below 132 to 134, then you don't want to be long. You're going to go down much more on these major averages. And on Microsoft, I think if you see it break below 322 to 325, that area, then that's going to put more downward pressure on the major averages. So besides the yield, if you said that starts to go up, keep an eye, especially on Google and Microsoft this week. I think they will give you, if you're looking to trade something thinking it's oversold, those would be two stocks with the price targets there. If they stay above that, I think you maybe can get a little bit of a bounce. But if they break those support numbers I just gave you, that 50-day moving average, then I think that you are going to see the selling pick up. And as you know, as they're overweighted in the Nasdaq and the Nasdaq 100, if they start to roll over, you're going to see that's going to bring the different indexes down even harder. But at this stage, I think you're going to see the earnings will be okay on both of them, which will allow hopefully this market to kind of stabilize a little bit, and maybe we do get a little bit of an oversold bounce here over the next week or two. Just keep an eye on that, especially also with the S&P 500, making sure that it's able to hold that 50-day moving average around 42.30. If it breaks below that, and in fact, as I'm speaking, we're at 42.32. So that's another thing to watch too. That continues to take out that 50-day or 200-day moving average on the S&P 500, and that probably implies that that will probably induce more selling with some of the bots and that kind of stuff. So at this stage, I think you're just kind of watching a couple different things. I don't see a lot of upside. I think your risk is to the downside, especially if you start seeing an escalation in the Mideast conflict. That's going to cause, that could spread things out and take stocks down. Historically, just so you know, when these things happen, any deep sell-off is usually very short. They usually bounce back as they start to envision and say, okay, well, how is that going to affect, McDonald's down the street, or some kind of clothing stores down the street or something like that. And you start to see some of these stocks bounce back. But I just think the risks to the downside are outweigh what's out there right now for the upside. And I would just be cautious and just kind of watch a couple of these things. I gave you a couple of things to look at if you really want to trade on a short term basis. And that's all we got for the week. But I do think, like I said, I do think we'll see earnings from the big caps. Just give enough that maybe we can see the market just trade kind of a sideways fashion here next couple of days.
Great. Thanks so much, David.
Oh, you're welcome. And like I said, we'll see. It's going to be a couple of rough weeks here, but we're not in a, if you do start to see things bounce because of because of earnings from the mega caps, don't think that that's the bell going off that we're going to have an end of year rally. There's still a few other things you need to watch besides just those big mega cap tech stocks, taking us higher. It's got to be a more broad based, um, uh, breadth before we can call it a end of year rally.
All right, sounds good. If you have questions for David or anyone else on the MarketEdge team, please feel free to reach out using that Chat Now button in the bottom right-hand corner of your screen, or send us an email at support@marketedge.com. David, thanks so much as always, and we'll see you next week.
Okay, sounds good.